Two stocks that are trading near their 52-week lows and have insane potential, Airbnb and UPS. So let's jump to our stock valuation sheets and plug in the ticker ABNB for Airbnb. So ABNB, and wait for all the metrics to show up. Now I made these sheets to help me evaluate any stock with the maximum efficiency and ease. So if you find them helpful after watching this video, make sure to check out my Patreon and download these sheets for your own personal use. Now right away we can see that Airbnb currently doesn't pay out any dividends, which I do like as they are quite a new company. They entered the stock market in 2019, which is about 5 years ago, and so they really need their free cash flow to develop their business. Now jumping to the 9-pillar analysis, where we will evaluate the fundamental historical values and see whether the company is doing well internally. So right away we can see that their 5-year PE ratio should be sitting below 22.5. It's currently sitting at 21.74, which means that Airbnb is trading at a fair value. Though if we do scroll down to the PE ratio, to the graphs below, we can see that through 2019 to 2020, the PE ratio was negative, and that was due to COVID. In 2021, the PE ratio was quite high, sitting at 30, as Airbnb was recovering from COVID, but in 2022 and 23, the PE ratio was sitting quite low, and in 2023 it was only sitting at 15.77, which means that the company was and currently is trading at a very cheap price. Now scrolling back up, we can see that Airbnb has also been growing their revenue. They have been increasing their free cash flow and growing their net income over the past 5 years, which is a must for every company, because a company's value is mostly tied to its profits. So with the profits growing, the company's value will be growing as well. Now another thing I want to have a look at is the long-term liabilities over the 5-year free cash flow, sitting at 0.28, which means that Airbnb currently doesn't have almost any long-term debt that they wouldn't be able to pay off. The value sitting at 0.28 means that they would be able to pay off all their long-term liabilities with about a year's free cash flow, which is very, very nice. Now their 5-year PE ratio, their 5-year profit margin is sitting at almost 80%, which is great, and they have been decreasing their shares outstanding over the past few years, which I love as well. Now scrolling through the graphs, we can see that the gross profit has actually been increasing slightly over the past 5 years, which I love. The revenue has been growing insanely, growing from about $4.8 billion in 2019 to almost $10 billion in 23. That's more than 100% increase. Now their net income, again through COVID years, was negative, but in 2023 it grew by more than 100% year over year from 2022. Scrolling further down, we can see the shares outstanding have been decreasing slightly over the past year. The free cash flow again has been growing very, very well. They currently don't pay out any dividends, that's why this graph is empty. Their long-term liabilities are increasing slightly, which isn't an issue at all, as their free cash flow is increasing much better. And scrolling to the earnings per share and the free cash flow per share, we can see that both are increasing. Currently the earnings per share is sitting at 7.24, which is very nice, and the free cash flow per share is sitting at 5.87, rising from only 0.37 in 2019. So overall internally, Airbnb is looking fantastic. But now let's calculate its intrinsic value. So first we'll jump to our Graham's formula revised, where we'll take the earnings per share of Airbnb, their base PE sitting at 7, the 5-year growth estimate, the growth rate multiplier, and the yields on AA Corporation bonds, the current yield, and the average yield, and we'll arrive to an intrinsic value of $176, which is 34% higher than the current trading price, showing us that based on the earnings per share, Airbnb really looks undervalued. But on this channel, I don't like to base the intrinsic value on a single valuation model, and that's why we'll also jump to the discounted cash flow model and the multiples valuation model. But first, jumping to the discounted cash flow model, we take the free cash flow over the past 5 years and calculate the average growth rate to be in this case sitting at negative 308, but that is because of the year 2020 and 2021. But we can see that overall the free cash flow has indeed increased from 2021 to 2023. So I calculated that the average growth rate would be sitting at about 20%. Now compared with the analyst growth rate projections and the research I did in the backend, I calculated growth rate of about 10% year over year over the next few years. And using that, I calculate the future free cash flow. Now I also want to calculate the present value of the future free cash flow so that I would account for inflation, and I will do that using the discount rate, which I plugged in at 12% based on the WACC of the company, and I calculated the present value of that future free cash flow. Then I sum all that up, add any cash and cash equivalents, subtract total debt, and get an equity value, which I divide by the shares outstanding and get an intrinsic value of $175.88, which is very similar to the intrinsic value we got in our grams formula. But now we can move to evaluating Airbnb based on its peers. So in the multiples valuation, we take Airbnb and we take the peers of the company and compare its earnings per share and their PE ratios. So I took these three companies, which are very similar to Airbnb. I took their current stock prices and divided by their earnings per share and got their PE ratios, which I averaged out and then multiplied by the earnings per share of Airbnb to get an intrinsic value of $212.67, showing us that Airbnb is indeed undervalued compared to the market, compared to its peers. Now jumping to Seeking Alpha and checking out the price return graph of Airbnb and its peers, we can see that over the past year, Airbnb has actually done the worst of all its peers, currently being down by almost 10%. Though if we jump to the 5-year chart, we can see that Airbnb has actually done quite well, returning almost 75% to its investors, only slightly behind Marriott International. Now, if we were evaluating a dividend-paying company, we would jump over to our dividend discount model, but as Airbnb doesn't pay out any dividends, we'll jump straight to our ultimate valuation, where we will average out the three valuations we just did and get an intrinsic value of $188.18, which is 61.05% higher than the current trading price. So even if I plug in a margin of safety of 20%, I still get an acceptable buy price at $150.55. So based on our valuations and our fundamental NIPER analysis, it really seems like Airbnb is indeed trading far below its fair value. So now near its 52-week low, this might be the best time to secure a position in this stock and watch it multiply your money. Though now let's jump to the second potentially undervalued company of this video, and that is UPS. So we will plug in their ticker and wait for the metrics to show up. So we can see that UPS has been beaten down quite bad over the past year. They're down by more than 20%. And the income and cash flow are both down. Now UPS, unlike Airbnb, does pay out dividends. Their dividend yield is sitting at 5.10, which is a very sweet dividend yield, and the dividend payout is at $6.52 per share per year. Now the trailing free cash flow payout ratio is sitting a little higher than I'd like to see. It's sitting at almost 65%, which leaves the company much less free cash flow to overall buy back shares or raise their dividends. Now regarding their dividend growth, as we can see, their dividend growth is sitting at almost 18% every single year. I wouldn't really mind UPS lowering their dividend growth and pumping more free cash flow into overall developing the company. We can see that the company is also decreasing their shares outstanding over the past 5 years. And again, if they were to cut their dividend growth, they could buy back more shares while sitting at the low value they are at today. Now looking over the other metrics of UPS, we can see that they have been growing their revenue, they have been increasing their free cash flow, as well increasing their net income, which is great. Their 5-year profit margin is sitting lower than the one of Airbnb, sitting at only about 23%, but that is still higher than what we want to see at the lowest of 10%. Now the 5-year PE ratio is sitting at 32, but if we scroll a bit down, we can see that they have been lowering their PE ratio rapidly, and currently it would be sitting at about 21, which means that the company is fairly valued based on their earnings. So now, like we did with Airbnb, we want to calculate UPS's intrinsic value. So we'll jump to our grams formula and we'll take the earnings per share, the base P, the 5-year growth estimate, growth rate multiplier, and the yields on the AA Corporation bonds and get an intrinsic value of $136.63, which is about $10 higher than the current trading price, which is 6% higher. Though now let's check out the discounted cash flow analysis. So we will take the average growth rate over the past 5 years and calculate it to be sitting at almost 45%. Now, based on the research I did and based on me being conservative, I will calculate a future growth rate of 4.2%, which I think contrasts quite well with the analyst growth rate projections. And using that, I will calculate the future free cash flow, and then plugging in a discount rate at 7.3%, I will calculate the present value of that future free cash flow, and adding all of that up and doing the whole process we did with Airbnb, we will get an intrinsic value of $131.94, almost $132, which is only slightly higher than the current trading price, hinting towards that UPS might actually be trading quite close to their intrinsic value. So now let's jump to our multiples valuation model, where we will compare UPS to its 3 peers. So we'll take their current stock prices and divide by their earnings per share to get their PE ratios, which will average out and multiply by their EPS of UPS and get an intrinsic value of $111.63, which in this case is lower than the current trading price, hinting towards that compared to its competitors, UPS's earnings per share are slightly below average compared to its industry. And again, if we check out the price return graph over the past year, UPS is down by almost 25%, which is the worst of all its peers. And jumping to the 5-year graph, we can see that UPS has only returned 15% of the invested value, which is again probably one of the worst returns from its competitors, with only STO sitting below it with a 10% return. But now let's jump back to our sheets and jump to the dividend discount model. And here we'll take the dividends over the past 5 years and calculate the average growth rate to be sitting at 18.09%. Now into the future, I will project a growth rate of only 3%, as I do believe that UPS will be to an extent forced to use their free cash flow to develop the company rather than increase the dividends. We'll also plug in a yearly dividend frequency of 4, as UPS does pay out its dividends quarterly, and using the discount rate, the same discount rate as we plugged in our the discount cash flow model, we will arrive to an intrinsic value of $142.67. And now finally jumping to our ultimate valuation, we will average out the 4 models and get an intrinsic value of $130.72, which is only 2.15% higher than the current trading price, showing us that UPS is currently trading at its fair value. So if we plug in a margin of safety of 20%, like we did with Airbnb, we would get an acceptable buy price at $104.57, meaning that we would still have to wait for UPS to drop lower to safely buy the company. And with that, if you are to decide between investing into Airbnb and UPS, I would personally invest into Airbnb because there's a much higher chance of a higher return than with UPS. I hope you did enjoy the video. Make sure to check out my Patreon and download the sheets for your own personal use. Make sure to leave a like and subscribe if you want to see more videos like this.